Hi there, my name is Gino Mapetere. I'm a tax lecturer at CAA Chartered Accountants Academy, and this recording is a VAT recording that can be used for both CTA and ITC courses. So from the name VAT, which stands for Value Added Taxes, this is a tax that is levied on value addition. Whenever there is value addition, VAT is an indirect tax. It's not charged directly on your income, and it is regressive in nature. This means that sometimes, so it does not necessarily follow that the more the income you get, the more the tax you are charged. In some cases, you actually get those who earn less having a higher propensity to spend. And since it's a tax on consumption, it means the ratio of what a person earns to the VAT that they pay is actually higher in lower income earning persons. Those that earn more tend to save more and have a less propensity to spend, a desire to then want to consume. So since this is a tax on consumption, it becomes regressive in nature when you look at things from that perspective. Now, going back to the name, value added tax. In any supply chain, you have value addition that is happening until you get to a final product that is then consumed, such as a shirt. A shirt bought by anybody, a head boy in Mzarabani, a business executive in Bulawayo, or a miner, a Korokoza miner in Kadoma or in Shurugi, will be bought from a retailer, who in turn has bought from a tailor, a manufacturer, who in turn has bought components to make that shirt, like the cloth, from a manufacturer such as in Zimbabwe we had a company called David Whitehead, and so on until we get back to the farmer who grew the cotton. Now, at each stage of the way, each of these players added some value. It is the portion that they added in terms of value as we were moving towards producing a shirt that is taxed, and each of these players or persons in this supply chain is taxed for the portion of the value that they added. The mathematical formula of coming up with this tax basically is just looking at what is called output tax, and then you subtract the input tax to get the VAT that you pay or a refund in the case where input tax is higher than the output tax. So how does this relate to what we've just talked about in terms of the value addition chain? Let's take the final retailer. Maybe it's Mickle's Departmental Store, Edgar's, or any retailer for that matter, selling the shirt at $12. But let's assume they've bought the shirt from the tailor at $10, which means they are making a margin of $2. When they sell, obviously assuming this commodity is a VATable supply and VAT has been charged, when they sell, the $12 includes VAT. It is a percentage of the selling price. But when they bought, they also paid VAT on the 10 because the seller or the tailor sold the shirt for $10 to the retailer. So collecting VAT on the 12, which is their price to their customer, to the headman, to the business executive, and so on and so on and so on. To collect VAT on the 12, having paid VAT on the 10 would mean that VAT is being collected more than once, and that would make the shirt very expensive. So the entire $12 for the shirt is the total VAT that must be collected on that shirt, and that's what we call the output tax, the tax that arises from the supply of the goods or the services. So what now needs to happen in order to levy only for the value that has been added? The retailer needs to subtract what they paid in VAT. So the VAT on the 10 that they paid is now deductible, and we call that input tax. The VAT on the 12 is chargeable, and we call that output tax. The difference becomes the VAT on the $2 between the 12 and the 10, and that ties in well with the value that has been added by the retailer. For us now to then determine this VAT on the $2, there are a lot of rules that need to be considered. It's not a straight selling price less buying price, and therefore the $2 multiplied by a percentage. There are a number of rules. First of all, does VAT arise on all transactions where there has been a sale of goods or services? Not necessarily. There are rules around whether or not we should be considering VAT, and we want to get into that. After looking at that, we'll need to know at what rate, assuming we should charge VAT, but at what rate? It could be a standard rate, it could be at 0%, or this whole commodity could be exempt. This ties in well with the introduction to taxes, where we discussed the whole story about taxes can be used as a lever for leverage to encourage or to discourage certain activities in the economy by the state. So, for instance, where certain commodities should remain with low prices, they could be zero rated, such as some basic commodities. Or certain transactions must be really encouraged, such as exports. They become also zero rated, making it cheaper for buyers outside the country because there's no VAT component to pay for. Certain commodities, such as fuel, are even exempt. Fuel and medical services. Fuel, medical services, educational services. So all these things, the rate is being determined to give the government leverage to encourage or to discourage certain transactions in the economy. So that's about the rate. The next thing we would worry about is when. It is not obvious that every time there is a sale, this is when VAT should then arise. VAT could arise when the goods are delivered and by the supplier, and although payment has not yet been made. Sometimes the customer pays before delivery or invoicing. So we need to have rules around when. And lastly, which value are we going to take? Why $12 for the shirt, going back to the shirt example? So these are four major issues that we're dealing with. Should we charge VAT in the first place? At what rate? When? And on which value? So we go through some kind of hierarchy where we discuss should we charge, and if the answer is yes, in the should we charge, the considerations there. If the answer is yes, at what rate, and there's a lot of considerations there. When, there's a lot of considerations there. Value, why 12? Is the 12 the replacement value, replacement cost? Is it the market value? Is it what was priced? We need to agree on all those. If the answer is no, we don't even need to worry about all these things about value, the time of supply, and the rate of supply, because the answer would be we should not even raise VAT. So let's jump into what are the things that we consider in trying to know whether or not we should charge VAT. And the last block of transactions which VAT must arise is whenever there is importation of services. My apologies, whenever there is a supply of goods through an auctioneer per section 56. So those are the typical 4 block of transactions where VAT arises. Whenever they arise, we should charge VAT, and we would need to go through each one of the 4. Let's start with block 1. It is about the supply by any registered operator of goods or services on or after the fixed date in the course of furtherance of trade carried by him. We need to know what supply is, and the Act casts a very broad net when it comes to supply. It simply says any supply is a supply. So the moment I pass on a commodity or goods or service from me to the next person, I have supplied. It's as broad as that. That passing on of goods or services from one person to another, never mind for what purposes, profit making, non-profit making, temporary passing it on, it's just you have supplied. The next key issue is it must be for goods or services. So you would have to go through the definition of goods. These have to be corporeal, and then you'll be told which goods are excluded from the definition of goods, such as money. So this you have to do. You have to go through the definition and understand what goods are. Then you'd also need to go through the definition of services to know what services are. Once you understand what goods or services are, whenever you are given a challenge or a problem to tackle, you'd need to be able to classify what was supplied, whether goods or whether services, because this will also have a bearing on the VAT that you want to charge. And this supply of goods or services must be done in furtherance of trade. So now we need to know what constitutes trade. So for trade, for us to then conclude that you were trading, there must be certain things which you need still to go back and have a look at in terms of the definition of trade. And it includes regularity, whenever you're doing a transaction regularly, whether or not for profit, but for as long as you're supplying and there is a consideration in exchange, which in turn you still need to understand what consideration can be. It could be barter, it could be consideration in the form of money, it could be forbearance. So there's a lot of other downstream definitions that you still need to keep studying and reading so that you're fully in the know of what consideration is, and in turn, which means if I get a consideration in return for a supply, then therefore it's moving in the direction of it being my trade. Very, very important. So in a typical assessment, there will be crumbs, there will be indicators in the scenario that are meant to test your judgment on whether you think this was consideration or not. Therefore, conclude on whether it was trade or not. If it was not trade, then even if there was a supply by a registered operator of goods or services, but if it was not trade, then no VAT arises, and so on and so on. Which is why this is very important to understand the components of this definition. And you also need to know things that ordinarily would have looked like trade, but then they're excluded from the definition of trade, such as remuneration. Whenever an employee offers a service that's a supply, and assuming the employee was a registered operator, and the service is employment services or labor services, and it's on or after the fixed date, and there is a consideration which is the salary, ideally this would have been a good candidate for should we charge, which means we would have said yes, let's charge. But specifically, employment services are excluded from the definition of trade. If there's been trading of employment services, it's not trade for VAT purposes. So these exclusions are also important, because otherwise, if you apply the general formula, it may pass the test, but it is excluded simply because it is not considered to be trade. So this is very important for application, but this whole definition of 6.1a excludes the supply of second hand. To section 12, so it's section 6.1b as read with section 12 within, which then defines these issues around when are the goods said to have been imported and at what value. After the goods have entered, so many things can happen. For starters, they could be freight, and that becomes a totally different transaction. Freight to premise of the importer. It becomes a totally different transaction. It's no longer part of the importation costs. Other things such as the claiming of that import VAT may also happen, and any necessary adjustments where you have mixed supplies. We'll get into that later. The next block of transactions for which VAT must arise is whenever there are imported services. For imported services, there must be a foreign supplier supplying goods to a resident recipient, a resident of Zimbabwe. And the supply that is being supplied by the foreigner, the service that the foreigner is supplying, the service itself must be taxable. What do we mean by that? A foreigner who comes through and supplies medical services is supplying a non-taxable supply. So even the imported service will not attract any VAT. But a foreigner who comes through and supplies legal services is supplying a taxable supply. So essentially, you read this with section 13, where once a foreign service is qualified in the definition of foreign service or imported services, VAT must then arise. Again, section 13 then guides you in terms of at what rate, when, and the value. Rather, the rate is not in section 13, but just when and at what value. Lastly, the fourth block. Whenever goods are sold by an auctioneer, VAT must arise, even if the owner of the goods is not a registered operator. However, all these rules do not. Since we've now dealt with whether or not we should charge VAT, and we've looked at the 4 issues in there, would now like to move on to assuming yes, we should charge VAT, at what rate? The rate of VAT could either be a rate for taxable supplies, which then becomes 0%, or standard rate, which is 14.5% for 2020. For 2019, the rate was 15%. Your non-taxable supplies are the exempt ones. So you have 3 categories: 0 rated, standard rated, and non-taxable supplies, which are. These classifications are very important. You have a list of exempt supplies. You also have a list of 0 rated. Anything that doesn't appear on the 0 rated and the exempt supplies becomes standard rated. Most of your 0 rated supplies are exports, but you also have other 0 rated supplies that may not necessarily be exports, such as your basic commodities selected, and these are found in the regulations. For your 0 rated supplies and exempt supplies, although the total VAT is nil in both cases, for 0 rated supplies, you are still then able to claim input tax. They're still taxable supplies, but taxable at 0, which means you can claim your input tax on them if you paid any. But for exempt supplies, although there's no VAT, just like in 0 rated, you cannot claim input tax on them. So these two are not the same. Candidates often use 0 rated and exempt supplies interchangeably, but this is incorrect. So moving on to the timing. When it comes to the timing, there are a lot of possible points in time which we can assign the trigger to charging VAT. These, for example, the time when a payment was made, the time when an invoice was raised, the time when goods were supplied but no invoice was raised and no payment was made. So all these different possible times that we can use require us then to create rules around the time of supply. Generally, they determine when a taxpayer should account for any output tax. And the general rule is whatever goes first, the date, the time of the invoice being issued, the time of the payment being made, or the time that the goods or services were delivered. But after that general rule, clearly we have to accommodate certain transactions which may not conform to the general rule. For instance, if you have 2 connected persons transact, it brings a complication in the sense that these 2 connected persons can manipulate the timing. They can agree on when they want VAT to be triggered, so they can manipulate that. And therefore, Section 8.2 brings in its own new rules for the time of supply of whenever connected persons transact. Section 8.3 begins to look at complex transactions such as leases, and within the leases you start having installment credit arrangements where a deposit can be paid now and payments made subsequent to the initial deposit. So although the commodity was already supplied, does it then follow that the delivery date becomes the time of supply? So the installment credit arrangement, this may or may not be the case. You also have rental agreements where in some cases the supplier is deemed to have successively supplied the same product for as long as the rentals are falling due. So section 8 is really about these times of supplies, and from 8.1, 8.2, 8.3, 8.4 about fixed property transactions. You have some about betting, you have repossessed goods. When are you raising the VAT on, and so on and so on. The common student pitfalls are around discussing an actual date in an assessment rather than discussing the principle. So for instance, if someone imports goods, the time of supply may not necessarily be, in your discussion, we're not necessarily looking for, was it the 31st of December, was it the 13th of December? We want to know how you pick the date, which means if it's an imported goods, we want to know it's the date at which the goods entered the country for home consumption. So those are the key aspects of time of supply. You have a general rule, you have specific time of supply rules, but you also have time of supply rules for adjustments. In adjustments, just in a nutshell, although we're supposed to deal with it in part 2, what we're saying is in some cases you have an input tax claim that is happening based on an estimate. For you to claim input tax, we need to know what you're using the goods for. So if you're not using the goods to make taxable supplies, you can't claim. But sometimes you're using it to make both. If you're using it to make both, you will only claim input tax on an invoice to the extent that you're using it. You're using those supplies to make taxable supplies. So you might need to do an estimate of the extent to which you will use the commodities to make taxable supplies. But later on, you may then realize that the estimate was incorrect. Either you overestimated or underestimated, and this triggers an adjustment. Now, this adjustment in itself may cause output tax if you are reversing an overclaimed input tax. And that output tax, the question is, when can you claim that? So in terms of time of supply, coming back to this diagram, we are saying there's the general rule, there's the specific rules, but you also need rules around adjustments to come up with a time of supply for adjustments. Then you also have some unique supplies that are not necessarily supplies as ordinarily they are, but they are just deemed to be supplies. An example, if you are leasing an asset, motor vehicle, just to further clarify that example, you are not selling the vehicle itself. What you're supplying there is the right to use the vehicle. However, section 7, which is the entire section on deeming supplies, deems you to have supplied the vehicle itself, although you haven't supplied the vehicle. It's about a deeming arrangement. Therefore, you are deemed to have supplied goods, and so the rules around goods from then on apply. Normally, the section 7 may then even guide you in terms of the time of supply and the value of supply. But even deemed supplies, we need to know when. What is the time of supply? 9.4 deals with where the transacting parties are connected. Clearly, once the transacting parties are connected, they would want to manipulate your transaction price, which can either lower or increase your VAT. And there are rules around that, and the commissioner in some cases even has the discretion to then determine the value of supply and the considerations. Then you have things to do with deemed supplies on cessation of trade. So at what value? Goods supplied under an installment credit arrangement, what is the value of that supply? Sometimes it works from a cash price, which is then deemed to be the consideration, and then once the cash price is deemed to be the consideration, you can work backwards to then determine the VAT or the value of supply. Goods sold and deemed supplies adjustments. so when you read with section 17, where the adjustments that then create output tax, such as an employer is deemed to have supplied goods or services when they give fringe benefits to their employees. So although it's a section 17.3 with a section for adjustments, it triggers the fact that it is now a deemed supply. So all these will have specific sections dealing with these adjustments and these deemed supplies. This is our first recording for part 1 of the VAT, and I hope you've found a few insights and how this will help you to further study and master the actual provisions that we have been referring to in this recording. I thank you.